Hi everyone, this is Derek Brink. I'm a Vice President and Research Fellow covering topics in IT security and IT governance, risk management, and compliance with the Aberdeen Group in Boston. And I'm glad to take part in this two-part webinar series with Aberdeen and Secunia. The topic is your vulnerability management program leaving you at risk? Most likely the answer is yes. So this is part two of the two-part series. And you either have seen or you have the opportunity to see Stefan Frei's presentation, and this is a companion piece to that. So let me take you now to my first slide. There we go. So just a quick summary here of what I'm telling you is also found in some research publications that I've done over the last couple of months. And these are available also on the Secunia website. In our research at Aberdeen, we found that companies perceive malware as both high incidence and high risk, but they're also spending a fairly significant amount, we see about $220 per end user per year on their vulnerability management initiatives, and that would include antivirus, patch management, configuration and change management. But upon further analysis, and this is consistent with what you saw in the other presentation, they may actually be ignoring and therefore accepting as much as 80 to 90% of their total endpoint security related risk. Now this material that I'm presenting today follows for the most part the flow of this second paper, which you see here on the screen. There are 3 papers in total. To put this in a business context, I'm referencing a line, I think, from one of the Terminator movies, The Rise of the Machine, but in this case it's the Unclean machine. Unfortunately, the headlines have been so common these days that some enterprise executives might actually sort of tune out and lose sight of the magnitude of the risk. But the fact is that the enterprise endpoints are in enemy-occupied territory. There's new malware by the millions being cataloged each year. Legitimate websites are increasingly being compromised by malicious code. Supermajority of all the email messages are spam. Phishing attacks are becoming more and more targeted and more socially engineered, aided by the power of social networking. There's hundreds of new updates and vulnerabilities identified each and every week. And all the while there's increasing diversity in the attack surface. And what we're talking about here is the networks, the platforms, the applications, all of these consumerization phenomena that we see that potentially can be exploited. So this is the context in which we're discussing this webcast and the other webcast here today. And so this really is a wake-up call for the risk-aware enterprise executive. What we are talking about, of course, is risk. And I'm borrowing very directly here from Secunia. These statistics actually come from their excellent work. But many organizations continue to perceive the Microsoft operating system and other Microsoft products to be the primary attack vector. But the vulnerabilities in the third-party programs represent also a significant increasing and often unappreciated threat. So this is analysis that you either have seen or can see later from Secunia. Their analysis of more than 2 million endpoints conducted last year found an average of 56 installed programs per endpoint, and these were from 20 different vendors. And the typical end-user PC with the 50 most prevalent programs installed had just about half and half from Microsoft and the other half from third parties, from a total of 14 different vendors. This typical PC had 3.8 times more vulnerabilities in the third-party programs than in the Microsoft programs, and over 5 times more vulnerabilities in the third-party programs than in the operating system. So again, if the perception is on Microsoft only, then there's a significant unappreciated threat that is not being addressed. Now, one quick analysis of this is shown here visually. You can do a simple analysis using publicly available data, including data from Secunia and other sources, just to underscore this importance. By my math, the Microsoft-only initiative would effectively cover only 10 to 20% of enterprise risk. And the simple reason is that, number one, not all enterprise endpoints are Windows-based, so that erodes the coverage, if you will, a little bit. You can see in the chart. Not all vulnerabilities and updates are for Windows-based software, which is another small erosion. Big fall downward here is that not all Windows-based applications are from Microsoft, and further, not all vulnerabilities and updates are for Microsoft apps. So if you continue to do this math and apply the statistics multiplying one to the other, you can see in the end it's somewhere between 10 and 20% of risks that are effectively covered if the focus is only on a Microsoft only vulnerability management program. So the real question for me here, and my contribution to this two-part webinar, is do Aberdeen's benchmark findings support this analysis? And I just put it again in context. There may be no such thing as perfect security. Companies like yourselves could invest an infinite amount on prevention and yet still experience an incident. But does the ratio of the cost of IT security initiatives that you're investing in versus the cost of IT security related incidents that you don't avoid in spite of those investments, does that ratio reflect the desired balance? This is a risk-based approach that we're talking about here again. So optimization of the trade-offs between the higher or lower investments in IT security initiatives versus the additional cost of IT security related incidents that you avoid or don't avoid, that's the real essence of this risk-based approach, and that's the approach I took in looking at the data that we have here through Aberdeen's research process. And so before I show you some of the numbers, I'll give you this simple framework for evaluating business value. What we did find in our studies was that on average there were $2.2 million per year amongst the companies who responded to our study in IT security related costs, and that averaged out, as I told you, that about $220 per employee per year. Now that might seem like a high amount, but in another context, many companies spend more per employee on complimentary tea and coffee, so everything's always in perspective. So a quick idea or simple-minded approach to calculating a return on annual investment is this little formula that I have here. On the denominator, we have the total cost of the vulnerability management initiative. This is the amount that you're spending to try to keep up with patching and configuration changes and so on. You'd like that number to be as low as possible. You'd like to be more efficient, in fact. But at the same time, there's other costs that the organization bears. Those are the costs related to the incidents that you didn't avoid in spite of the investments that you've made. And those are factored into this denominator as well. Those are the total investment, the two of those together, the investments that your company makes. Now what you'd like to do, obviously, is move as many of those as you could from the non-avoided category on the denominator to the avoided category on the top. That would be a sign of effectiveness. So the real simple idea here is that any investments in technologies and services that can lower your total cost of your initiative, in other words, be more efficient, and cause a greater shift from the denominator to the numerator in terms of data loss, data exposure, incidents avoided, all those kind of things that relate to the VM initiative, in other words, effectiveness, that will have a positive impact on the ROI. So for the respondents in our study, again, you can see it was about 870 plus 1280K, which adds up to that $2.2 million number. One more just quick thing to position this, and then I'll show you the actual findings. We do need to keep this always in context. Keeping cost avoidance and cost savings in context is very important. It goes directly into this risk-based approach. What we found at Aberdeen over the course of about 4 years now of studies, the very consistent finding is that the best companies, we call them best in class, they focus first on security and then compliance, and then they focus on being well managed. And they do it in that order. Security first, and then compliance is the order, because in doing it in that way avoids overlaps, which are expensive and wasteful of resources. It also avoids gaps, which leave you more vulnerable to risk. But security and compliance first, and that cost non-avoided, trying to drive that towards zero there on the little chart by number 1. That's what we see here for effectiveness. You also want to have the amount that you're spending on the initiatives sort of on the operational side drive closer to the origin as well, and that would be an example of cost savings and being well managed and efficient. All that being said, and all that still being true, we have the enablement side. It's always for the purpose of enabling. The reason we have these endpoints that we're worried about here is so people can do work. We're looking for the company to do its business. We're looking for innovation and growth. And so that's the metaphor here of the helmet is one I happen to like. Oftentimes you see security viewed as a metaphor with a padlock and key. And I like the helmet metaphor a little better. I think it speaks to protection. I think it also speaks to enablement, because the goal is to ride the bike or the skateboard or what have you, and to pursue these things. But you have to do so with a mind towards risk and compliance and governance. So here's what we find when we look at the data, that the overall IT security investments look like they're accepting about 60% of the risk. Now, I've shown you in a table here for all organizations in the study, and then I broke it down here by size of company, large, mid-size, and small. And I also just, for this audience, I thought you might be interested in seeing it by geography. So I have the Americas, EMEA, and Asia Pacific. A quick definition of large, middle, and small. Large companies are defined by annual revenues in the order of $1 billion or higher. Mid-size is $1 billion down to about $50 million annual revenue, and small companies are defined by $50 million and under. Americas, EMEA, and Asia Pacific, you can use standard definitions. So we can see, for example, that small enterprises are investing disproportionately more than the mid-size or the large companies in terms of total cost not avoided as dollars per employee per year. In terms of a percentage of annual revenue, they're investing a higher amount, 4%. I mean, that turns into real money. It's a material financial impact. When you look at the third row of the table, though, that's really that row in the bottom row. Those are the ones to focus on here. The ratio of the total cost that you didn't avoid to the amount that you're spending to try to avoid them is what you see in row 3. And then you can do the math and come up with the percentage number there. That's a translation here. That's the percentage of risk which you're effectively ignoring or accepting above and beyond your current investment. So overall, it's about 60%. But you can see by size of company, it ranges between 40 and 80%. And by region, it ranges somewhere between 60 and 70%. So this analysis actually gives credence and support to this previous conclusion and the data that Secunia has shared, that companies ignore or accept the risk for a very high percentage, and in fact as high as 80 to 90% of their endpoint-related vulnerabilities. Now, what are the barriers to effective risk management? This is some data. In this case, it's broken down by the size of company. I'm showing you some of the factors that are barriers to doing a better job. So point number 1, I've kind of tried to annotate on the slide here. Larger companies, which you'll see in the rust color, the highest bars over there, they're struggling with risk being managed in silos. You know, just because of their size, they tend to have a lack of integration. They have siloed management sometimes of vulnerabilities and so on. They also lack some of the IT-based risk management capabilities, and you see those as the top 2 reasons there over by number 1. At the other extreme, we have small businesses, and they're struggling with things just like purely risk allocation. They just don't always have the resources or don't prioritize those resources for risk management to be as high. And they're 2 times more likely to act after the fact. In other words, we only know if something goes wrong after it happens. You can see the blue bar as highest there in the areas that I've tried to annotate with the number 2. So these are some of the barriers to being effective at managing this kind of risk. Now, when we look at this same data cut by geographic region, we can see that there's less differentiation between the Americas, EMEA, and Asia Pacific with respect to these barriers. You can say, I think, from the data, just you can inspect it yourself visually, but you can see that the Asia Pacific region lacks slightly in terms of having the IT infrastructure and the ability to identify and track and measure these kinds of risks. Now, how risk management is carried out is the data that I'm showing you here, and you can kind of think of it along the x-axis here as a spectrum. On the left-hand side, we don't do any explicit risk management at all, to we do it in an intuitive and ad hoc way, to manual and paper-based, to spreadsheet-based, which is quite common, as you can see, to the beginning of automation within applications, to integrated across applications, and ultimately to be probably the ideal scenario, which would be the proactive and predictive. What I've done here is just show you again by size of company, large, medium, and small, and I've kind of overlaid on top of that with the dotted lines here, a smooth curve, if you will, to see where they are across this spectrum. And what you can see with point number 1 there is more than half of the small businesses, that's in the dark blue here, they manage risk intuitively, ad hoc, or not at all. That's the point, unfortunately, that's made by annotated by number 1. On number 2, and that's focusing on the mid-sized companies, you can see that nearly 3/4 of them, 71%, manage risk intuitively or by paper or spreadsheets. So that's probably the most common scenario for a lot of companies today. And 1/3 roughly of large organizations, to point number 3 there on the right-hand side, are starting to at least to use technologies to automate, integrate, and predict. So you can see that the biggest bump in that curve that I've overlaid there is shifted furthest to the right by size of company. So the larger companies are investing more resources because they have more at stake. Now, looking at this by geography, the same data really by geography, the point would be made that there's less differentiation between the regions with respect to how risk management is carried out, according to Aberdeen's data. And by the way, this is looking at nearly 900 respondents globally, as you can see on the y-axis there. But in the Americas, they're most likely to have no explicit risk management initiatives, and that's noted by number 1 there on the annotation. EMEA and Asia-Pacific regions are most likely to use technologies to automate, integrate, and predict, so they're shifted furthest to the right, and you can see that annotated here for number 2. So Americas are lagging here in this regard. Since we're talking about risk, I thought I'd add to the conversation just this observation. There's 2 types of risk, really, the unrewarded type and the rewarded type. I've also drawn, the pictures here, just the analogies. That's a carrot and a stick, if you will. But our research at Aberdeen consistently shows that the top performers in our studies, as I mentioned, first focus on security and then on compliance and then on operational efficiency. So the goal is to ultimately to free up resources related to the rewarded risks. Those are the kind of risks that you want to focus on. If you focus exclusively on the unrewarded risks, you're kind of missing out on an opportunity for IT security to be seen as an enabler, or better still, as an advisor for the business. So these 2 types of risk, if you look in the table, you can see here. There's the unrewarded types are the objectives have to do with protection of value, defending assets, minimizing downside. Rewarded risks are focused, on the other hand, for creating value, enabling assets, maximizing upside. You can see the difference here. In terms of areas of focus, unrewarded risk would be things like vulnerabilities and threats and compliance. Rewarded risk would be about innovation and growth and operational efficiencies, as we were talking about before. The kind of assets that you're concerned about on the unrewarded side would be identities and access and applications and data and infrastructure and physical infrastructure and personnel safety, all the usual stack. On the rewarded side, the focus is on revenue streams, distribution channels, products, services, operations, and supply chain, that kind of thing. And so you need both types of risks. Both types are required. It's kind of like cholesterol. You need to have both to be healthy, but too much of one and not enough of the other can lead to other problems. So the idea is to do as efficient as a job as you can on the unrewarded types and free up those resources to focus on the rewarded types. They're involved in transactional services that underpin a wide range of high-volume critical information exchanges. Examples of that would be payment card processing, email, call center processing, even orders on financial markets. So they support about 48,000 employees and annual revenues of in the neighborhood of 5 billion euros. So one of their key elements of their strategy is to globalize their IT, which coordinates and standardizes across all these issues involved with security and service continuity and risk and so on. So they have this effort, which is managed by global project teams, and they're trying to refer common policies and leverage common tools to get to those efficiency and effectiveness points that we've been talking about. Now, viable solutions have to be multi-platform in nature, given their widespread leverage of systems other than Windows, such as Linux. So the initial driver for getting involved with vulnerability management was a solution from Secunia to standardize the priority rating of the many vulnerabilities that they were identifying and to establish a consistent risk-based view across this entire company about the urgency to deploy patches. They were trying to manage this by themselves. In other words, they were more on the left-hand side of that continuum that we were talking about. They're trying to move towards the right, and that's just savings of time is the initial reason they stepped down that path. In the second phase, they're looking to focus on increasing the level of visibility and control over the end-to-end vulnerability management process, so more to the right side of that spectrum. And they do see this as a continuously evolving process, as you should as well. They pointed out that in the beginning, the reason they got started is becoming more standardized now with industry standard scoring systems, and what they're looking at and emphasizing currently is more on managing and automating vulnerability management and patch management processes throughout the life cycle, especially in the area of getting feedback and reporting after the patches have been deployed. And again, you can hear more about that from the Secunia part of this two-part webinar. So some summary and recommendations here quickly. I would make the observation that senior management already understands the importance of managing vulnerabilities as part of their overall risk management obligation. However, they really should take a closer look at the third-party vulnerabilities to make sure that they're not inadvertently accepting risks by ignoring them. And given that they're compelled to invest in managing unrewarded risks, it really is in their best interest to do it as efficiently and as effectively as possible, again, and free up those resources to work on other more strategic projects. So I think I've got about 3 high-level recommendations here. The first one would be to take a comprehensive approach. The top performers really do excel across that entire vulnerability management lifecycle, from initial assessment to prioritization and ultimately to remediation. They focus on efficiency and minimizing the total cost, which acknowledges the necessity of this continuous approach to vulnerability management. It's not a one-and-done thing, it's a continuous operation. The multi-application approach is also critical, especially given what we've talked about here, that the typical Windows-based PC, there's more than 3 times more vulnerabilities in the third-party apps than in all the installed Microsoft programs combined. And for the most organizations, a multi-platform approach is also important because they happen to have multiple platforms, and speed and accuracy are key solution selection criteria for sure. Another recommendation that should come through loud and clear here is to take a risk-based approach. What we see in our research is that the top performers quickly determine which vulnerabilities and threats should be addressed first, based on the level of risk and the business value of the IT assets in question. Stefan talks about that in his part of the webinars here. Selection criteria for VM solutions in this case should include visibility and intelligence that you can glean to provide insights, rankings, and recommended priorities for remediation. Another recommendation here, which should make good sense given what we've talked about, is to have an optimized approach. As I've mentioned, the top performers tend to focus on being secure and compliant and well managed in that order. Well managed, which is ultimately the goal, is to be both more efficient, meaning lower total cost, as well as more effective, for example, by using automation to reduce cost and reduce the windows of vulnerability. And this, as we've said, has the additional benefit of freeing up those precious resources from working only on the unrewarded risks, such as vulnerabilities and compliance and so on, and to focus on those rewarded risks, such as projects for innovation, productivity, and growth. Now here in summary is a slide with some links here to Aberdeen.com where you can find some related research. There's some examples here on this table. There's also my email, derek.brink@aberdeen.com. So if you have questions that aren't addressed here, you can always ping me directly there. And just as a reminder, you can see both parts of this 2-part webinar at secunia.com/resources/webinars. So it has been my pleasure to contribute this part 2. I hope you'll take advantage of seeing both parts 1 and part 2. I want to thank Secunia for allowing me to participate with them, and thank all of you listeners for your time. Thanks and take care.